Lehman Brothers fell on September 15th, sparking the deepest financial shock since the Great Depression. Bear Stearns was already bought out for almost nothing. Washington Mutual collapsed, the biggest bank failure ever in U.S. history. AIG required an $85 billion federal bailout to prevent the whole insurance sector from going under. The S&P 500 dropped 57% from its high to its low. Retirement funds were cut in half within 18 months. That was your parents' savings. Perhaps yours too. Housing values plunged 30% across the country, over 50% in overheated markets like Las Vegas and Phoenix. 10 million people in America lost their houses to foreclosure. 10 million households saw their life's work repossessed by lenders. That was your neighbor, your colleague. Maybe it was your own family. The homeowners who mocked renters in 2006 were sending their keys back to banks by 2009. 2 times before. Same alert, same wait, same result. Same self-assured experts proved disastrously incorrect, and it's unfolding again now. In August 2022, the yield curve flipped. The cautious analysts began sounding alarms. And just like in 1928, just like in 2006, hardly anyone paid attention because equities claimed all was well. You're seeing the same film for the 3rd time. You already know the ending. Here's why this flip is unique. It's lasted 27 months. The 1928 inversion ran 17 months before the crash. The 2006 inversion ran 16 months. We've already moved past both periods. This is the longest continuous inversion on record. And it's not only longer, it's steeper. The spread between short and long-term yields hit points that equaled or even surpassed both 1929 and 2009. The bond market isn't merely cautioning, it's shouting, louder and longer than ever before. So why hasn't the collapse occurred yet? That's the question everyone uses to ignore the indicator. 27 months and still going. If it were real, shouldn't something have broken already? You've likely heard that reasoning. You've probably told yourself that at 3 a.m. while questioning your financial choices. Here's what they overlook. The delay is the threat. In every past instance, the longer the pause between signal and crash, the heavier the eventual fall. The yield curve doesn't forecast the date, it forecasts the order. Signal, pause, collapse. That order has never been wrong. The market climbing after the inversion doesn't prove the signal false, it proves the drop will be steeper. 17 months of gains before 1929 came before an 89% plunge. 16 months of gains before 2008 came before a 57% plunge. We're now at 27 months. What does that calculation imply for what's ahead? But there's another reason the crash hasn't hit yet, and that reason just ran out. When COVID struck in 2020, the government injected trillions into the system. Stimulus payments, enhanced jobless benefits, business aid. Americans built up over $2.5 trillion in surplus savings, cash they otherwise wouldn't have owned. That buffer soaked up the impact. When the yield curve flipped in 2022, households could continue spending because they had pandemic cash reserves. Companies could continue hiring because demand remained solid. The alert was live, but the hurt was hidden. The shield held. That shield is gone now. Surplus savings are fully exhausted. Credit card balances have soared beyond $1.14 trillion, a new peak. Average credit card rates are above 22%. Car loan defaults have reached levels unseen since 2008. The padding that guarded the economy from the inversion's impact has vanished, and the inversion remains active. Look at what's forming beneath the surface while you're told things are fine. While CNBC cheers record highs and the Federal Reserve hints at gentle landings, credit card defaults are silently reaching levels last seen during the prior crisis. Corporate failures are climbing at the quickest rate since 2020. Commercial property stands 40% empty in big cities, with debts maturing that cannot be refinanced at today's rates. Full-time jobs are declining, while part-time and multiple job positions grow. The top appears stable. Below, the same fractures that came before 1929 and 2008 are widening. And here's what people are claiming. Federal Reserve officials say inflation is managed. Wall Street strategists forecast ongoing expansion through 2025. The same strategists who missed 2008. CNBC airs pieces on a soft landing secured. Former Treasury Secretary Janet Yellen stated the economy is surprisingly durable. The same phrases. New speakers, new era, the same result approaching. But here's what could make this round worse than both 1929 and 2008. Examine the debt. In 1929, household liabilities were modest relative to earnings. The borrowing was focused in stock gambling. Painful when it reversed, but limited. In 2008, the debt was focused in real estate. Mortgages, HELOCs, mortgage-backed bonds. When housing fell, that particular debt collapsed. Brutal, but traceable. You could name the issue. At Finance Infinity, we don't sell fear. We sell preparation. The data is clear, the pattern is proven, and the clock is ticking. Warnings like the yield curve inversion are not opinions. They're historical facts with a 100% track record before every major recession. When markets ignore risk for too long, the correction becomes inevitable. Our mission is to help you protect wealth before the sequence completes. Because once the collapse begins, the only question left is whether you positioned yourself before it or became part of it. Stay ahead with Finance Infinity.